a lot of mischief can happen with derivatives. And as we pointed out, Charlie and I have seen it happen when there's a derivative transaction, particularly a complicated one. The plain vanilla ones, probably people will not get in big trouble on. But when you have a complicated derivative transaction and the trader at investment house A is on one side and a trader on investment house B is on the other side, and they record a transaction which has to be a zero-sum game between the two of them, and both put on the books a profit that day. I've never seen one where they both put on a loss that day. It lends itself to mischief, and the scale is absolutely huge and getting larger all the time. And I will tell you that I know the managements of some of the companies that have big derivative activities, and they do not have their minds around what is happening. A lot of things correlate in the securities world that people don't expect to correlate, and there are people following similar strategies all over the world, as happened when long-term capital had its problems. And the financial world, operates on a hair trigger to some extent. People want to jump the gun and move just ahead of the other fellow. And when you get huge amounts of transactions, which many people only vaguely understand, you are creating a potential huge problem that may come about because of some other exogenous event that triggers defaults on a huge scale, and that can be very disruptive to financial markets. So we think they're dangerous as used in society. We use them ourselves, incidentally. You know, we get them collateralized. We've made money off of them. But I would predict that sometime in the next 10 years that you will have some very big problems that will either be caused by or accentuated in a big way by people's activities in derivatives. Charlie?
Yeah, I think part of the trouble you were talking about came because people didn't think enough about the consequences of the consequences. That's a common error. You start trying to hedge against interest rate changes, which is a very complicated thing to do when you've got a mortgage portfolio where people have options to pay the mortgages off early. And then, under the accounting conventions, the hedges started making the quarterly results lumpy instead of nice and regular the way all the institutional analysts like them. So then they use another bunch of derivatives to smooth out the returns. Well, now you've morphed into lying. Well, it's complicated enough to start with, but when you add lying to the process, it's a Mad Hatter's Tea Party, and yet this happens with eminent directors of vast financial sophistication sitting on the board. It shows that the sophistication won't save you. Somebody has to have the common sense to say we're just not going there. It's too tough.
Charlie was on the audit committee at Solomon and changed it into 6 and 7 hour meetings. I think you found mismarks that were in the tens of millions of dollars on a single contract with a place with many tens of thousands of contracts. Isn't that correct?
I think it's fair to say that it was bonkers and that the accountants sold out.
Mm-hmm. It's interesting stuff. You might, if you feel in kind of a nasty mood, you might go to a shareholders meeting of some company that has very large positions in derivatives and grill the CEO a little bit about some of the more esoteric transactions. They get very, very complicated. They get mind-boggling in terms of trying to figure out the consequences. I think actually there is much more risk in the system because of derivatives than the proponents of derivatives would say has been dispersed because of the activities. Last year and the year before, I think I said that derivatives often combine borrowed money with ignorance, and that is a rather dangerous combination. And I think that we've seen some of that in the last year. When you can engage in sort of non-physical transactions that involve hundreds of millions or billions or tens of billions of dollars, as long as you can get some party on the other side to accept your signature. That really has the potential for a lot of mistakes and mischief. And if you've looked at the formulas involved in some, particularly, I guess, interest rate type derivative instruments, it is really hard to conceive of how any business purpose could be solved by the creation of those instruments. I mean, they essentially had a huge, really gambling element to them. And I use that in the terms of engaging in a risk that doesn't even need to be created, as opposed to speculative aspects. They involve the creation of risk, not the transfer of risk, not the moderation of risk, but the creation of risk on a huge scale. And it may be fortunate that in the last year, half a dozen or so cases of people who have gotten into trouble on them have come out, because that may tend to moderate the troubles of the future. The potential is huge. I mean, you can do things in the derivative markets. Well, I've used this example before, but in borrowing money on securities, the Federal Reserve or the U.S. government decided many decades ago that society had an interest in limiting the degree to which people could use borrowed money in buying securities. They had the example of the 1920s with what was 10% margin, then was regarded as contributing to the Great Crash. So the government, through the Fed, established margin requirements and said, I don't care if you're John D. Rockefeller, you're going to have to put up 50% of the cost of buying your General Motors stock or whatever it may be. And they said that maybe Mr. Rockefeller doesn't need that, but society needs that. We don't want a bunch of people on thin margins gambling, essentially in shares where the ripple effects can cause all kinds of problems for society. And that's still a law, but it means nothing anymore, because various derivative instruments have made 10% margins of the 1920s, look like what a small-town banker in Nebraska would regard as conservative compared to what goes on. So it's been an interesting history. And like I say, perhaps the experiences of the last year, they've got everybody focused on derivatives. Nobody knows exactly what to do about them. Berkshire Hathaway will, if we think something makes sense, and Charlie and I understand it, we may find ways to use them to what we think will be our advantage. Charlie, you want to add anything on that?
Well, I disapprove even more than you do, which is hard. If I were running the world, we wouldn't have options exchanges. The derivative transactions would be about 5% of what they are, and the complexity of the contracts would go way down. The clearing systems would be tougher. I think the world has gone a little bonkers, and I'm very happy that I'm not so located in life that I have to be an apologist for it. A lot of these people, I feel sorry for them. They had great banks, and they have to go before people, sometimes even including their children and friends, and argue that these things are wonderful.
The question is about derivatives. We have in this room the author of the best thing you can read on that. There was an article in Fortune about a month ago or so by Carol Loomis on derivatives, and far and away is the best article that's been written. We also have some people in the room that do business in derivatives from Solomon, and it's a very broad subject. As we said last year, I think someone asked what might be the big financial story of the 90s, and we said we obviously don't know, but that if we had to pick a topic, that it could well be derivatives, because they lend themselves to the use of unusual amounts of leverage, and they are sometimes not completely understood by the people involved. And any time you combine ignorance and borrowed money,
you can get some pretty interesting consequences, and particularly when the numbers get big. And you've seen that, of course, recently with the recent Procter & Gamble announcement. Now, I don't know the details of the P&G derivatives, but I understand, at least from that what started out as interest rate swaps ended up with P&G writing puts on large quantities of U.S. and I think one other country's bonds. And anytime you go from selling soap to writing puts on bonds, you've made a big jump. And the ability to borrow enormous amounts of money, combined with the chance to get either very rich or very poor very quickly, has historically been a recipe for trouble at some point. And derivatives are not going to go away. They serve useful purposes and all of that, but I'm just saying that it has that potential. And we've seen a little bit of that. I can't think of anything that we've done that would. Do you think of anything we do that approaches derivatives, Charlie? Directly?
No.
No. I may have to cut him off if he talks too long. Is there anything you would like to add to your already extensive remarks? I'm sorry.
No.
Okay. In that case, we'll go to zone 2.